Hello and welcome to your Learn Forex course by Learn to Trade, in association with Capital Index and Smart Charts. Please make sure that before you proceed any further with this video that you've watched and followed the steps in the pre-course setup video. That way you'll have Smart Charts fully installed, ready for your Learn Forex course, and you'll also have a live trading account with Capital Index so that you can get straight into the markets during your training program. If you already watched the video, great, let's get stuck in. Now, we can teach you how to trade, or we can teach you how to make money from trading, and there's a vast difference. You've probably already been online, you've seen several other websites on how to trade, you may have tried to use some of that information for yourself, but the fact is, learning how to trade, there's so much information out there that as soon as you start trying to delve into any real portion of it, there's just too much going on. What we prefer to do at Learn to Trade is to teach you how to make money from trading. You see, you don't need to know absolutely everything. You don't need the almanac on trading. What you really need to know is what to do and when to do it. Now, people study absolutely everything, and this is a complete waste of time. It's one thing to look at the encyclopedia of price action and something else on something else, but ultimately all you really need to know is the important stuff. You've got to keep it simple. You need to know what to do, when to do it, and also, of course, how to do it. Now, if you don't know that, you're going to end up frustrated and broke. And the idea of this course is to make sure that we keep things as simple as possible so that you know when to push the button and so that you know exactly what you're doing when you push the button. Now, we're going to be showing you specific usage of price action and indicators for a very simple, singular purpose: what to do and when to do it, and how to use technical factors to create an understanding of the big picture as to what's really going on. What that really means is context. You need to know what's going on around you first of all, before you can jump into the nitty-gritty. So we look at the basic, simple, big picture first of all, and then you can zoom into a greater level of detail after that. And throughout this program, you're also going to be provided with time-tested, proven systems and strategies that work. We're going to be showing you how to identify a trend. We're going to be showing you when and how to enter and exit the marketplace, how much to risk per trade, how to manage most of your trades onto a profit, or if you're going to lose, how to lose as little as possible. Of course, you also need to know how to highlight the next trading opportunity, and also how to manage your entire trading portfolio, your entire trading account. Now, we do that over a series of modules so that you can see exactly what to do and when. Now, you're going to be learning 4 trading systems or 4 trading strategies throughout this online program, and they're called the 180 Profit Booster, the Income Wave, the Money Market Breakout, and the Interbank Radar. They primarily trade trends, and the reason why they trade trends is because that's where most money has been made trading the forex markets. Some systems are incredibly simple, and some are a teeny bit harder, but on the whole, by the time you've been through this program, you'll know exactly how all 4 systems work, you'll know exactly how to place those trades, how to risk manage those trades, and ultimately the most important thing, how to make money using those trading systems. Now, there's a very simple process that we follow, and we call it the road to success. You've got to first of all drop you in the safe zone, and that means learning how to manage your risk. You need to make sure that if you lose, it's a small amount that you lose so that you've still got enough capital left to stay in the game. If you risk too much and you blow your account, you can't play the game anymore. So risk management is a pivotal point that we need to focus on to make sure that you know how to stay safe in the markets. Alongside risk management, there's also strategy or system-based trading. Now, that's where the trading systems come in, and if a trading system sets up, you take the trade. And the third part here, traders applying discretion. This is really a filter, and it's something that can't necessarily be taught to you straight away, but something that you gain yourself through experience in the markets. Traders applying discretion doesn't get you into any more of the winning trades. What it does is keep you out of some of the losing trades. And if we can keep you out of some of the losing trades, ultimately you make more money overall. Now, Smart Charts is a great piece of software because it risk manages for you, so it keeps you as safe as possible. It's got the trading systems and the trading strategies hard-coded into it so that when you push the button, it knows how to look after the trade for you.
And then you can then improve on this with your own discretion as you become more experienced in trading the markets. But smart charts makes things as simple as possible, saves you time, and ultimately makes it easier for you to make money. Now, smart charts is looking at quite a few things in the background. It's going to be looking at price action, it's going to be looking at moving averages, it's going to be looking at exchange rates, advanced price action patterns, cyclicity, and risk management. And it's doing it all simultaneously in the background so that you haven't got to. At the same time, we want you to understand what's going on, so we've got different modules for you on these different subjects so you understand exactly what each thing is. Now, there's more to it than just smart charts itself. You have to understand there's two parts to trading. There's the technical mastery, but there's also the emotional mastery. Now, the technical mastery we'll be looking at in lots of different ways in different modules. We'll be looking at it in smart charts as well, and smart charts knows a lot of the technical things so that you necessarily don't have to. But the emotional side has also got to be covered. You need to have both aspects to become a consistently profitable trader. Now, price action, quite simply, is historical prices on the chart. And what has happened before gives us a good indication as to what is likely to happen next. Looking at a chart, first of all, what I want to do is give you an understanding as to what a basic chart looks like. So what we're going to do to begin with is take a chart and strip it down into the individual sections so you understand exactly what's going on. Now, the first thing to look at, of course, is price action itself. Now, price action are these little red and green bars on the chart, and they're drawn for you by the smart chart software, and essentially what you're going to be seeing is these red and green bars drawn over time. Now, how is price action actually created? Well, it's created because we have prices running at the right-hand side of the chart. So prices will always be here, and they're quoted in something called pips. And if I zoom in a bit so you can see here, we have the prices there on the right hand side, and you can see the numbers corresponding there as well. Now, prices on the right hand side work alongside dates and times along the bottom of the chart. Now, dates and times, it depends on what time frame you're looking at as to whether you're going to be seeing dates at the bottom or whether you're going to be seeing times at the bottom. If you're looking at a higher time frame chart, it's going to be showing you the dates. And if you're looking at a smaller time frame chart, it's going to show you the times within that day. And we're going to look at the price section here as well in a later module in more detail, so you understand exactly what pips and prices really are. We've also then got moving averages. They're those wavy lines that run through the chart shown in the yellow and blue colour. Now, moving averages help us to understand the direction that the market's moving. Again, there's going to be a whole separate module on this so you understand how it works. But so you've got a basic understanding, we use moving averages to work out the direction of the market. Moving over to the left-hand side now, we can see what's something called the mini terminal. Now, the mini terminal over here, if we look at the top, right now we can see that it's saying no trade. Now, no trade obviously speaks for itself and means that there's no trade setup currently in play. However, there's 4 different stages to a trade setup that we'll look at in more detail in later modules, but there are no trade being in red. We then have amber that will say wait. We then have green being get ready, and we have green flashing that will tell you, of course, the all-important buy or sell. Now, again, in a later module, we'll be looking at exactly how that works so you understand when you need to click the button. And underneath that mini terminal, we have something called the market watch. I'm going to zoom back in again here for you so you can see what it is, but basically it's a list of all your different currency pairs, and you'll also notice gold and silver sneaking in there as well, which are commodities that you're going to be starting off trading. Now, we've deliberately given you 12 currency pairs plus gold and silver to get started with because you don't want to be looking at 37 different symbols when you're first starting. You want to be looking at a set group of symbols that you know give you a good chance of making money and of course are cheap for you to trade as well. That's exactly what we've done on the left hand side here. We've deliberately made sure you've got the all important symbols when you're first starting out. We've also then got the wavy lines at the bottom of the screen here, which are where the indicators and the oscillators sit. Now, it might look scary to begin with, but we're going to look at this in more detail when we look at one of the trading systems. But essentially, the indicators and the oscillators tell you whether the market is too strong or too weak at present. And we'll be looking in more detail at that later on. Now, as you move over to look at these OHLC bars, this price action itself, what on earth are OHLC bars? Well, OHLC bars are called this because the price bars themselves have got an opening price. Now the open price is essentially the start, the beginning of the bar. Let's say we're looking at a 1 day time period. That's the beginning of the day, the start point. We then have the high price. This would be the high of the day, the highest price that was reached over that period of time. Looking towards the bottom of the bar, we then have the low price that was reached throughout that day. And over on the right-hand side of the bar, we can see the closing price, which is the finish point or the end of the bar. Now, these price bars are drawn for you by the Smart Chart software, and they're created over time. They don't just appear, they're actually built. And when you've got the closing price above the opening price, that means that buyers have actually won that bar. Therefore, it's color-coded green as a buyer bar. And that's again, if the close is above the open, we have a buyer bar. Now, of course, the price doesn't just go straight up forever. We've also got seller bars as well. So, if we look at the right-hand side here, we can see we have seller bars as well. These two will be drawn for you by the software. And again, we have the OHLC bar here so we can see it. O for open, the start point of the bar, H for high, L for the low, and the C for the closing price or the end price of that bar. Now we can see that these bars are built for us over time, and of course they're color coded as red for seller bars. That way you've got green for buyer bars, red for seller bars, easy to identify if the market's been moving up or down throughout that period of time. Now it's not just OHLC bars that we can look at. We can also see candlesticks. Now candlesticks are another way of viewing the price, and it's a little bit more complex than the OHLC bars, so we do tend to recommend that people stick to the OHLC bars to begin with. However, so you know what's really going on with these candlesticks, you can see if we look at the high price and the low price, if I jump backwards and forwards, you'll see that the high price and low price remain exactly the same, whether you're looking at a candlestick or whether you're looking at an OHLC bar. Now, the biggest difference really comes from the open and the closing prices. With an OHLC bar, you can easily see the open and the closing prices displayed by the little knob on the left and the little knob on the right, so you can see the open and the close. However, on candlesticks, you can't easily identify it, and you kind of have to work it out for yourself. Now, why on earth would we use candlesticks? Well, they seem to be the popular thing that people move on to a little bit later on through their trading journey. They tend to be color-coded exactly the same colors, but again, we do recommend that people stick to the OHLC bars to begin with because it's much easier for beginners. Now, they give us exactly the same information, and it is your own personal preference, but as it says here, we're going to be using OHLC bars going forwards. Now, the next question is, how long does that OHLC bar actually last for? Well, the simple answer is, it depends on which chart you're looking at. We have charts as low as a 1 minute chart, which means that each bar lasts for 1 minute, all the way up to a 1 month chart where each bar lasts for 1 month. And you can see all the individual time frames in between, 5 minute, 15 minute, 30 minute, and you can see underneath the M5, M15. Basically, if there's an M in front of the number, it means minutes. If there's an H in front of the number, as we can see here, H1 and H4 being 1 hour and 4 hour. We then have daily being D1, weekly being W1, and monthly on the end there being MN. Now, not all time frames are created equally, and we're going to be using certain time frames that give you the best chance of making money. We're going to look first of all at what not to do. Now, you'll see here I've highlighted certain sections, and I want to start at the weekly and monthly charts to begin with. Now, if we look at the weekly and monthly charts here, they're what we call investing charts. They're higher time frames, and people that tend to buy and hold stocks over the long term, that's what they're really trading weekly and monthly charts. Now, that might sound good, but why don't we want to use them in forex? Well, we don't want to use weekly and monthly charts. Quite simply, it takes too long for us to get paid. So we're going to leave those alone for now. On the other end of the spectrum, we've got the scalping charts. As you can see over here, the 1 minute chart is what's been selected. That scalping chart on the end. Now, Why would we look at that scalping chart? Well, the scalping chart there, the 1 minute chart, that's really where computers are going to be. And we aren't really focusing too much on the 1 minute chart because it's just too difficult for us to make money. It's just too fast. The next group, we've got day trading charts, 5 minutes, 15 minutes, 30 minutes and 1 hour charts. If you want to spend hour upon hour in front of the screen, great, go to the 5 minute, 15 minute, 30 minute and 1 hour charts, but they don't really give you the time versus money balance that you're after from trading. And that's the reason why what we look at the 4 hour and the daily charts. We focus on those because they give you the best chance to make money in the smallest time invested, and ultimately that's what you're after. Now, if you had to choose between the daily and the 4 hour charts, I would say that the daily charts are the best place for you to get started because, again, it requires the least amount of work for the best return possible. Now, more money is traded during the London session than any other session, and this is because London shares trading hours with both the Asian and American markets. We also actually tend to stick to the London time zone purely because London has over 40% of the forex market's volume. So simply we'll always be using UK time as our central time zone when trading. Now, if we start to break down the individual bars and understand what's really going on, of course, we've learned about these OHLC bars, but we also need to understand when they open, when they close, and a bit more about them. So the daily chart's what we call the long-term trend chart, and it gives us the strongest overall picture of price action. And you'll see here it actually says it's the 10 p.m. UK open and 10 p.m. UK close. Now, why on earth does it open and close at 10 p.m. UK time? Well, that's because essentially one trading day runs from the morning in New Zealand all the way through to the evening in New York. And that is UK time, 10 p.m. till 10 p.m. So 10 p.m. UK time, Sunday night the markets open, through till 10 p.m. Friday night the markets close. And every day at 10 p.m. one bar will close and a new bar will open. Now, the step down from a daily chart takes us to the 4 hour chart. And the 4 hour chart is what we call the medium-term trend chart. Now, you're going to get more trade setups on a 4 hour chart, which means you're going to have to spend a bit more time in front of the screen. That being said, you're not going to be there every 5 minutes, so it's not the end of the world. But every 4 hours, you're going to get a new bar appear. Now, the higher the bar is the higher the 4 hour period now, and the lower the bar is the low of the 4 hour period. And every 4 hours, we're going to get one bar close and a new bar open up and start moving along. And again, the time frame down from a 4 hour chart, which you won't be trading straight away, is the 1 hour chart. And it's called the short-term trend chart. Now, we get more trade setups here than we do on a daily and a 4 hour chart, but it's not going to be our main focus. You're going to be focusing on daily and 4 hour charts to begin with because they give you the best chance to make money from the smallest time invested. If you were going to trade a 1 hour chart, you'd need to be in front of the screen at the same time every hour. Now, asking you to come back to the screen on the hour every hour is not really something you're going to be doing. So you can see why we stick to those slightly higher time frames. Now, if we put those three time frames side by side, you'll see that we have 1 day, but now we've actually focused on what 1 day looks like on those different time frames. So first of all, taking the daily chart here, we can see on the daily chart, we get 1 bar here on a 1 day period. So 1 bar, 1 day, daily chart makes sense. Now, that same bar, if we break it down into 4 hour bars, we've got this whole section here going on where there's 6 bars inside of this area. So essentially we can see here, that's what we're looking at. That is the actual 6 bars through there, and there's 6 4 hour bars within a day. And a step down from that again, there's 24 1 hour bars inside the day. And we can see here 24 1 hour bars within a daily bar. Now, if we look at that 1 hour chart, there's a lot more of what we call noise. And we don't really trade a 1 hour chart to begin with because of that noise. It makes it more difficult to make money. Whereas if we focus on a higher chart, like a daily chart or a 4 hour chart, we've got the best possible chance of making money. Here we can see I've got a 1 minute chart on the screen. And I've deliberately brought a 1 minute chart up so you can see the prices actually being built over time. So you can see these bars actually moving. They don't just suddenly appear. And what's going to happen is as soon as one bar closes, the next one will then open up. So we'll just sit and watch this now, and you'll see as one bar closes, the new one will open up. And to give you an idea, as looking at the chart, there's a grey line and a red line. They're showing you the sell price and the buy price. And we can see the bar, as it closes, new one opens up, it's going to start moving around again straight away. Now, we don't know what colour the current bar is going to be. It might be green right now, but it could quite easily become red and change throughout that bar. So you need to be aware we never know what the current bar's colour is going to be. It's always the last closed bar that we know it was a certain colour. Okay, so to summarise, price action is historical prices on the chart right up to the current price. And it gives us an idea as to what's likely to happen next. It's displayed with OHLC bars that we can see on the charts here that are built over time. And the different time frames that we have to trade, from the 1 minute chart that we're looking at right now, all the way up to a monthly chart and all the different time frames in between. Of course, we know that some time frames are better than others, and you're going to be looking at the daily and the 4-hour charts, because that's where you stand the best chance of making money with the smallest time invested. In this module, we're going to be looking at exchange rates and prices. Now, you need to understand exactly how currencies are priced in order to be able to trade them. So we're going to be looking at what pips are, how to use them, how you collect them, and how you ultimately make money from them as well. Now, when we're looking at a basic chart, on the right-hand side of the screen, we already know that's where you're going to be seeing your prices. Now, the prices have got numbers to the left and right of the decimal place, and somehow pips works out into all of this as well. So you need to really understand what those numbers mean in detail, and this is going to be a case of making sure that you know what the pips are and how to collect them. Now, currencies are traded in what we call currency pairs. There's always obviously 2 currencies as part of a pair. Now, let's just backtrack a second to make things really simple and just think of a stock, because everyone understands stocks initially far easier than anything else. So think about Apple. Everyone understands and knows Apple. You may even own an Apple product. But Apple, you don't just trade the Apple share price. You have Apple US dollar. So it's actually Apple against the US dollar, and Apple's priced in US dollars. All we're doing with currencies is substituting Apple against US dollar, getting rid of Apple and inserting a different currency. So, for example, euro against US dollar, or pound against US dollar, or Australian dollar against US dollar. There's lots of different currencies to look at, and you'll notice that they're always abbreviated down to 3 letters. EUR for euro, USD for US dollar, GBP, Great British Pound, and so on and so on and so on. Now, you'll also see, looking at the right-hand side here, that we've got an actual price, 1.22456. So when you price these against each other, what we're saying is, what's €1 worth in US dollars? Or what's £1 worth in US dollars? And we get a price that we can then work with. Now, when we start to look at pips and we start to look at prices and exchange rates, you need to first of all understand what pips actually are. Now, pips stands for price in points. And very simply, a pip is a unit of measurement. Just like centimetres or miles, you get the idea. Now, prices are always quoted for most symbols to 5 decimal places. There is an exception. The exception is the Japanese yen, and we're going to look at that separately in the next couple of slides. But for now, looking at the vast majority of currency pairs you're going to be looking at, they'll be quoted to 5 decimal places. Now, starting at the right-hand side, it might seem a little bit counterintuitive, but you always start at the right-hand side because that's where tenths of pips are going to be. Now, people might think the last number's pips. It's not. The last number is tenths of a pip. So that 5 at the end there is actually 5/10ths of a pip, not 5 pips. Moving one along to the left now, looking at the 4, which you'll notice is in the 4th decimal place. That's the pips column. So the 45 at the end isn't 45. It's 4.5 pips, or 4.5 pips. Looking across now, we can see the 3rd decimal place. We've got the tens of pips. So 345 is 34.5 pips. 2nd decimal place, we've got hundreds of pips now. So that's 234.5 pips. And looking at the first decimal place, we can now see we're looking at thousands of pips. So 1, 2, 3, 4, 5 is in fact 1,234.5 pips. Now, that's all looking at the right-hand side of the decimal place. As soon as you jump across to the left-hand side, everything just continues on. So from thousands of pips, we're now looking at tens of thousands of pips. Now, basically, if that number at the front moves, you're talking 5 years for that to happen. It's a very slow process for that. But most of the time, what you're going to be focusing on will be the tens and the hundreds of pips. Now, why is that? The tens of pips, anything less than that isn't really worthwhile turning up to work for. So pips themselves, when we collect them, we really collect them in batches of tens at a time, and ideally hundreds at a time. Now, we don't really stray too far into the thousands or the tens of thousands, because as soon as you're looking at those kind of categories, it just takes too long to get paid, and it's unlikely your trade's going to go that far. So in the vast majority of cases, tens of pips and hundreds of pips. Now, I mentioned earlier it's a little bit different when you start looking at the Japanese yen. Now, the Japanese yen is different because it's roughly 100 times greater than the US dollar. So 100 yen doesn't buy you anything, basically. It's actually less than $1. So if we, it's a lot less than a pound. So if we go and look at the Japanese yen, you won't see 1 point some numbers. You'll actually see 100 or 110 point some numbers, because that's kind of roughly where we are right now. Now, again, pips stand for price in points, and you'll see at the top of the screen here, I've got exchange rates. This is just for the Japanese yen. Now, looking at this 100.123, the biggest difference you'll notice is that the decimal place has moved. If we think back to the other way of doing things, for most other symbols, the decimal place would have been here, and we'd have been looking at 1.00123. All that's really happened with the Japanese yen is it's moved across 2. Simple as that. So decimal place moves across 2, and everything is the same as it was before. That is, the last number at the very end of the right-hand side, in this case it's the third decimal place, that's where you're going to be seeing the tenths of a pip. So that 3 at the end there will be 3/10 of a pip. As we then see, we've got the pips next. That's the second decimal place. So second decimal place now, we're looking at pips. So 2-3 at the end is 2.3 pips. Looking at the next one, where the number 1 is there, we can see that's tens of pips. So this you'll be fairly familiar with. As we now go across onto the left of the decimal place, we'll see we have hundreds of pips, we have thousands of pips, and of course next we have tens of thousands of pips as well. Now, if you remember back to the other currency pairs, we tend to be looking at tens and hundreds. It's exactly the same here with the Japanese yen. We're primarily going to be looking at tens of pips and looking at hundreds of pips. Now, the reason why we're doing that is because that's what's likely to occur, what's realistic to actually happen. Anything less than tens isn't really going to be worthwhile turning up to work for, and anything more than hundreds is just not likely to get there. Now, I mentioned in a previous module on price action that there's 12 currency pairs that you're going to start off trading. Now, if we look at those 12, we can see they're abbreviated down to 3 letters each.
You're also going to be able to trade gold and silver.
Now, we need to understand what's really going on in the background. Now, the broker will take care of this for you, but it's just nice to know what's really going on. Now, when a chart's going up, we have here what we call an upward trend. Now, in this upward trend, there's going to be more buyers than sellers, and that's pushing the price to the upside. Now, with price being pushed to the upside here, and it being what we call a buyer's market, you want to buy that market as well. Now, if you're going to buy that market, essentially you buy that currency pair. So we're going to buy the euro US dollar. Now, when you buy the euro US dollar, you just literally buy the pair. You haven't got to worry about, oh, do I buy euros or do I sell dollars or what do I actually do here? All you do is buy the euro US dollar. And what will happen is the broker in the background will take care of the complicated stuff for you. Now, on the way up in this upward trend, you're actually buying euros. That's what's really happening there. So when you buy euro US dollar, it's the euro that's going up against the US dollar. And we expect prices to go up. As we then go and look at a downward trend, we see the market's moving down. Now, if the market's moving down, we want to be a seller. Now, this is where people usually get a little bit confused, but you can sell something before you've bought it. Now, that doesn't make that much sense, but how can you do that? Well, you can sell something before you've bought it because whenever you sell something, you're actually making a promise to buy it back in the future at some point, whether it be a higher or a lower price. You can't pass it on to your next of kin or anything silly like that. So when you place a trade, you're basically saying you're going to exit it at some point. So when you place a sell position, you're going to be buying it back again later on. Now, if we look at this in terms of the euro US dollar that's moving down through here, you sell the euro US dollar. Now, if you're selling the euro US dollar, the broker in the background is selling euros, buying US dollars. Now, that's what's actually happening. How do I explain it to you so you fully understand that? Because that's not the easiest thing to understand, and most people do struggle with selling something before they've bought it. Well, think of it like this. If we backtrack and look at that upward trend, the euro dollar going up, imagine if you could change it round to dollar euro. If the euro dollar was going up, so if euro dollar was going up like this, the dollar euro would be going down. It would be doing the opposite. Now just bear that in mind, because if we now look at a downward trend, if the euro dollar is going down, the dollar euro is going up. Now, you can't trade dollar euro. No one quotes it. It's not a priced currency pair. So essentially, when you sell euro dollar, you're buying dollar euro. Now, if you can't quite get your head around that, just imagine that you're betting it's going to go up or you're betting it's going to go down, because that's essentially what you could be doing as well. And thirdly, if you can't get your head around either of those ways, just accept it. You can sell something before you've bought it, and you'll find out as you go on and you actually start placing trades that you'll be able to sell something before you buy it. Now, if we move on from here, just a little bit of terminology so you understand. When we say we want to buy something, traders will tend to say they want to go long. Long is buy, and you'll see on the other side there, short is sell. And you can see the big arrows there, long being buy, short being sell. So if I say I'm long the euro US dollar, I'm buying the euro US dollar. If I'm shorting the NZD USD, I'm selling the New Zealand dollar US dollar. If you enter a long trade on the euro US dollar, what are you doing? Well, if you enter a long trade on the euro US dollar, you're buying that currency pair. And if we buy at 1.28456, let's look at this now. If we're going to buy at 1.28456, remember that 6 at the end there is tenths of a pip. Now, if we're going to buy at 1.28456 and your target is going to be 50 pips higher than that, so 1.28456, add on 50 pips, what would be your exit price? Have a think about that now. If you enter a 1.28456 and you add 50 pips onto that, what's your exit price going to be? Remember, the 6 at the end here is tenths of a pip. You want to be adding 50 pips on top of the 1.28456. Now, what does that look like? Well, if we've got the 1.28456, as I've just mentioned, the 6 at the end is tenths of a pip. So for now, we can discount that. Now, if we look at the 1.2845 and add 50 onto the 45 at the end there, you'll see that becomes 1.28956. The 6 just neatly gets slotted back on the end again. So all we've really done there is 45 add 50, and we've got to 95. So 1.28956. Now, that's great, but what does that actually mean for you when it comes down to money? Well, let's just talk in pounds sterling for a minute, so Great British pounds. And if you'd risked £1 per pip and you'd made 50 pips, how much money would you have actually made? Well, 50 pips times by £1 per pip, of course, you'd have made £50. Simple enough so far. Now, as we progress a little bit further through here, What happens if you're risking £3 or £5 a pip? Well, we said that we were going to be exiting at 1.28956. We said at £1 a pip, we made £50. We're still making 50 pips, but now each pip is going to be worth £3. So now we're looking at £150 of profit. I'm sure you'll agree that sounds a lot better than just the basic £50. And as we go on from there and look at £5 a pip, then we're looking at a £250 profit. Now, what determines how much you risk per pip? There's actually several different factors, and I don't want to confuse you too much, but to keep things simple, first of all, it depends on your risk percentage. Secondly, it depends on the money you have in your trading account. And thirdly, it also depends on the size of your stop loss or your risk as well. Now, as we go through later modules, you'll understand exactly how that works. And in fact, smart charts will actually work that out for you. But the important point for you to take away from this is that money makes money. The more money that you've got in your trading account, the more money you stand to make. So you can see one person trading at £1 a pip compared to somebody else trading at £5 a pip. It's not a fair comparison. Now that's great when we're buying, but let's now flip it on its head and look at selling. So we've deliberately got these in different boxes. If we look at selling now on the short side, so you enter a short trade on the GBP USD. And we're going to be entering at 1.67656. But now we're selling, we're expecting price to go down, not up. So we're selling the pound against the US dollar and we're actively looking for the price to move lower. And our target being 40 pips, we want the price to move 40 pips lower than our entry price. So have a think, what's that 1.67656 minus the 40 pips? Remember that 6 at the very end there is tenths of a pip. So 1.67656 minus your 40 pips. So if we think about that now, the 1.67656, well, the 6 at the end, we can forget about that for now, so long as we remember to add it back on again at the end. But the 1.6765, take that 65 at the end there and take 40 off of that. So 1.6765 actually becomes 1.6725. And of course we add the 6 back on the end again. So if you're selling at 1.67656 and you want to make 40 pips, your exit's going to be 1.67256. Now, you might be going, hang on, but price has gone down. How on earth have I made money out of that? Sure, the pound dollar has gone down, but the dollar pound has gone up. So selling pound dollar is exactly the same as buying dollar pound. But as I mentioned earlier, you can't buy dollar pound. So you have to sell pound dollar. And that's exactly what you've done in order to make your 40 pips. Now, if you've risked £1 per pip, so each pip being worth 1, you've made 40 pips. That's a fairly simple one. You've made £40. Let's say now that you've risked £3 per pip, so a little bit more, £3 per pip times by the 40, you've made £120 on exactly the same trade. And at £5 per pip, we're looking at £200 on that trade. Now, if we say that person 1 has risked £1 per pip, person 2 has risked £3 per pip, and person 3 has risked £5 per pip. If we think about it from that perspective now, who's done the most work? Person 1's risked £1 a pip, person 2's risked £3 a pip, and person 3's risked £5 per pip. Well, the answer, of course, is they've done exactly the same work. But one person's made a lot more money, so person 3's made the most, and person 1's made the least. And ultimately, it comes down to capital. Again, the more money that you've got in your account, the more money you stand to make. Now, why have we used these £1, £3 and £5 per pip examples and not 10, 20, £30 a pip? Well, it's because to begin with, in our experience, most people tend to start out somewhere between 20 pence a pip up to £5 a pip. Now, why is that? Well, 20 pence a pip is the absolute minimum that you can risk. Therefore, some people obviously start there. And we tend to find with most of our clients that £5 a pip tends to be the maximum they go to, of course, when they're first starting out. As you progress through your trading journey, you're going to be expecting for those numbers to get bigger and bigger. Now, targets. What are you going to be aiming for on a regular basis? Your target is 100 pips per week on average. Now, that 100 pips per week on average, you could do 90 pips in week 1, 125 in week 2, 75 in week 3, and 110, 115 in week 4. As long as you're averaging your 100 pips a week, that's the important point. But how do pips and percentages actually work out? Where does all this tie together? Where does money come into this? Well, 100 pips a week, if we look at that in terms of per month, 100 pips a week, roughly speaking, 400 pips per month. Now, roughly speaking, 400 pips a month, in percentage terms, they're not directly translatable, but it tends to work out somewhere around 4% per month. Now, that's your initial target that you want to be aiming for, and once you get to that level, your goal is to exceed that. And with what you're learning, you're going to be learning to go up to around 150 pips a week. Now, 150 pips a week, taking you up to around 600 pips a month, and that works out, roughly speaking, around 6% a month. And that's really the kind of the level you're looking at getting to with this program. 4, 5, 6% a month is really where you get to. And that, quite frankly, that's a great return because you don't get that in a year from the bank. So getting that per month out of your trading account is an awesome level of return. So in summary, your goal is to collect as many pips as possible. But realistically, that's going to be up to around 100 to 150 pips a week, with 100 pips a week being around 4% growth per month, and 150 pips a week getting you up to around 6% growth per month. Now, we collect pips by buying or selling. We buy in an upward trend, and we sell in a downward trend. And we trade with the trend because the trend is your friend. So we make sure that we're buying on the way up and we're selling on the way down. There's 12 different currency pairs you're going to be looking at, and also gold and silver as well. That's more than enough to keep you busy to begin with, and you can always add more symbols or more currencies to your watch list if you want to. And again, you want to be collecting 100 pips per week as an initial target. That is your goal. And that way we're growing our accounts by around 4, 5, 6% a month. And that ultimately is the name of the game. In this module, we're going to be looking at cyclicity. Now, cyclicity is all about how the market moves, how the market breathes, and of course, how the market cycles. Now, markets don't just go straight up, they don't just go straight down. So you need to understand the ins and outs as to how the market moves in order to be able to make good money from it. First thing is, it's all about the big picture, as it says. Now, you can't just zoom straight in and look at the nitty-gritty. You have to know what's going on in the big picture first of all before you jump in. You need to make sure that you stay safe and stay with the overall market momentum. Now, I don't know if you know how large the forex marketplace actually is, but on average it's 5.3 trillion US dollars per day. Now, when you put that into context against, for example, the UK's yearly GDP, our yearly GDP in the UK is 2.25 trillion. So by lunchtime day one, forex has done more. It's that kind of scale. Take the big old United States of America. Their yearly GDP is just under 15 trillion. 3 days, forex has had more money pass through it. It's that bigger marketplace. Now that means that little old retail trades when you're first starting out, retail traders make up around 10-11% of the marketplace. Most of the marketplace is banks, institutions, hedge funds, and they're the ones that ultimately drive the marketplace. And they create waves. They're dealing in amounts of money that, quite frankly, you can't imagine. And they're creating these ripple effects that we can, the waves, so to call it, that we can then take advantage of. So big picture first, then zoom in. Now, if we look at the chart, when a chart's moving, you need to understand cyclicity, because if you don't get the hang of cyclicity and you just understand the direction the market's moving, it's highly likely that you'd get caught out. Now, cyclicity helps you to understand the best time to get in and the best time to get out of a market to capture the best possible profit. Now, how do we do that? We look at price cycles over time. Now, there's a funny little saying, trade with a trend, because the trend is your friend until the bend at the end of the trend. It's corny, but it works. If a market's going up, you're only allowed to think about buying it. If a market's going down, all you want to be thinking about doing is selling. If you try and buy when the market's going down, good luck. Similarly, if you try and sell when the market's going up, good luck. Cross your fingers, because you're going to need to. You need to make sure you're on the right side of the market, because the big players that are driving the marketplace, when they get involved, it moves and it moves and it moves and it doesn't come back. So you always trade with the trend. And cyclicity helps you to understand the best times when the market's trending and the best times to get into that trend. Now, if we look at this screen here, so we can see both an upward trend and we can see a downward trend. Looking at first of all, on the left-hand side on the upward trend, we can see that the market's moving up. Now, great, overall the market's moving up. Where's the best place that you could buy there? Well, you might logically say, well, hang on, I'd like to buy down here somewhere. That's easy in hindsight, but you can't do that in real time, because in real time, you didn't know it was going to go up. So we use these cycles to understand how the market's moving and to see if the market's moving higher or if the market's moving lower. And in upward trends, you can see I've drawn these lines on. Market don't just go straight up. There are these pullbacks against the trend. You can see these pullbacks against the trend, and they're actually a great time for you to buy into a rising market. So you're buying an upward trend, but the market's currently in what we call a bit of a dip. So essentially what we do is, in an upward trend, so in uptrend, we buy dips. Those pullbacks in the upward trend, that's a great place for you to buy into the marketplace and see the market rally in your favor very quickly. Now, when we're looking at a marketplace moving down, like on the right-hand side here, we can see overall there's more sellers than buyers. And if we're looking at this falling market, we know that we want to sell, but where do we sell? Well, we wait for these peaks. These areas that peak, as they roll over, this is where we want to be getting into our trades, back into the overall momentum of the marketplace. Now, we're never going to do this absolutely perfectly every single time, but as long as we get it right more than we get it wrong, we can see there's a lot of movement that can work out in our favor. And cyclicity helps you to understand where these zones occur. Now, taking things and making them very, very simple with a nice graphical representation, we can see here that we've got some circles, some lines, and something that says complete cycles. Well, you need to understand what's going on here. Price cycles. And first of all, looking at the overall trend, this line here is saying, do you know what? The market's overall moving to the upside. Now, we then get these moves that go with the trend, but of course we also get these moves that are against the trend as well. And you ought to notice something fairly early on, in that the moves with the trend, like so, tend to be bigger than the moves against the trend. And that's the reason why we're trend-based traders, because more money has been made trading with the trend than any other method. So it's a really sensible place to start. Plus you can see, and seeing is believing there as well, that the moves with the trend are bigger, and also something for you to be aware of, moves with the trend are easier to predict. So again, all round the easiest place for you to make money. Don't go and make things more complicated and trade against the trend until you've really got the hang of trend-based trading first of all. Now, let's just take up this chart and actually add a few more things to it now and label it as well so you can see what's going on. But essentially you'll see you need to have two complete cycles to identify a trend, and two complete cycles will look like this. So we can see here that we have phase 1 going with the trend. So phase 1 here going with the trend, and it tells us that just up here. Phase 1 goes with trend, and phase 2 goes against that trend. Phase 2 against trend. Now, one move with the trend, phase 1, and one move against the trend, phase 2, gives you one complete cycle. So there's cycle 1. But in order for us to be an upward trend, we actually need 2 cycles. So we're playing it safe to make sure we've got a strong trending market. So we also need to see this next phase 1 and this next phase 2. And now we've got ourselves a second complete cycle. That now means we've got a confirmed upward trend. As a result, you'd now want to buy into this upward trend. And you notice that phase 1 is longer than phase 2. Phase 1 should be longer than phase 2. Now, why is phase 1 longer than phase 2? Quite simply because it's in the direction of the trend, so the momentum is in its favour. Now, if we buy, for example here, the momentum being in our favour means there's a very good chance we're going to hit our target somewhere along here. Now, there's 3 things that make up every single trade that you place. You're going to have an entry level. An entry level, quite simply, is where you get into the market. You're also going to have what we call a stop loss, where if it all goes wrong, you get out of the trade and you lose your 1%. And you're also going to have a target level, or TP, known as take profit. And as price moves and gets to that take profit level, that's where you get taken out of your trade for a profit, ideally in that phase 1. Now, let's assume that we've got a slightly bigger target than ordinary. Let's assume we're targeting up here somewhere. Now, you can see that the phase 1 doesn't quite get there, and we have to sit through this phase 2. But the great thing is, if you're trading with a trend, the trend will go for longer than you expect. So it's very likely that the next phase will go and hit our take profit. Wonderful. But if we were to trade against the trend, we wouldn't have the momentum against us. So quite frankly, in those phase 2s, most people don't want to take a big position. They're cautiously seeing if the market's going to go down. It's not a seller's market. So what I'm basically saying is, you want to be trading phase 1s, you don't want to be trading phase 2s. We're going to go and have a look now at what all these little circles are, so you can understand what they show you. But very simply, they show the change between phase 1 and phase 2, and they're where you should be doing something. Think of them as an action point. Now, as we look at cyclicity here, and we look at those little circles, you'll see now that they've been numbered 1, 2, 3, 4, and 5. I'll just highlight them now so that you can see. We've got circle 1, circle 2, circle 3, circle 4, and circle 5. Now, I've already mentioned they're an action point where you want to be doing something, but they're not all created equally. On the way up, we know we're in an upward trend here, we want to be buying. And if we want to be buying, that will give you a bit of a clue as to where you might like to buy. And for example, you don't really want to buy at 4 because it's going to go against you. You get the idea. Now, 1, 2, 3, 4, and 5 are what we call advanced price action patterns. There's a whole separate module on those later on, but what we're looking at right now are the zones where we want to buy and the zones where we want to sell. And the options that you've got, you can choose to do nothing. Nothing is an option. Nothing, or not taking a position, is taking a position. Okay, you can always choose to do nothing because, you know what, if you're not happy the market's trending, doing nothing could be the sensible option. You've also got the option to enter a buy trade or exit a buy trade. And of course, entering a sell trade and exiting a sell trade. It's not just as simple as saying buy here, sell here. You've got to think about entering and exiting those trades. Now, I'm going to give you an example before we go into a practical. So we can see here at point 1, let's say we enter our buy trade at 1. If we enter our buy trade at 1, the next thing we must do is to exit our buy trade. So if we were, for example, to exit our buy trade at 2, we'd have just completed that trade. Now, we can do more than one thing at each of these circles, at each of these action points, let's call them. We could also enter a sell trade, for example. I'm not saying it's right or wrong, I'm just giving you an example at this point. But we could enter a sell trade on the way down, and we could then exit that sell trade here. Now, why do we term it enter a buy, exit a buy, enter a sell, exit a sell? We term it that way because if you just simply said buy and sell, you wouldn't know whether you're trading the phase 1 or you're trading the phase 2. It's not particularly articulate or clear. So we always use enter buy, exit buy, and enter sell, exit sell, so you know exactly what you're going to be doing. Remember, if you enter a buy trade, the next thing must be to exit that buy trade. Similarly, if you enter a sell trade, the next thing must be to exit that sell trade. What I'm going to ask you to do now is take a few minutes and pause the video and work out what you want to do at 1, 2, 3, 4, and 5. Now, assume that the market is already trending at point 1. So we're assuming we've already got our 2 cycles, we're assuming the market's already trending, and decide what you want to do at 1, 2, 3, 4, and 5 from the options on the bottom right-hand side. So go ahead now, pause the video, decide what you want to do at those action points, and then start the video again when you want to go through and review the answers. Okay, so let's take a look at the answers now. So, essentially, in an upward trend at point 1, what you'd like to be doing there is entering a buy trade. Why do you want to do that? Well, if the market's trending up at that point, bearing in mind we already said we're going to assume the market's trending, then it makes perfect sense to enter into a buy trade. Buy low, sell high and all that. Now, if we're buying low here, we're entering here, we now need to exit this buy trade next. So at point 2, that's exactly what we're going to be doing. We're going to be exiting that buy trade. Now, between 2 and 3, you actually want to do very little. You want to do nothing at all between 2 and 3. In fact, just stay out of the marketplace. And you want to wait till point 3's happened, and then you can enter a new buy trade. So this is completely separate from the first one. This is a new buy trade now. And you want to hold that trade as long as possible up to position 4, where you then exit that buy trade. And again, in the phase 2, leave it alone, do nothing, wait until we get to 5, where you can enter a new buy trade again. Now, at number 5 there, that might feel a little bit scarier than 1 and 3, because you can't see what happens next. But that's exactly where you're going to be in real time. So you need to get used to it. You need to get used to making decisions with incomplete information. Because once it's happened, you can't make money out of it anymore. Everything on the right-hand side of the chart you can make money from. But everything on the left-hand side of the chart you learn from. Now, you'll see on the way up there, you don't want to sell anything. You're not even allowed to think about entering or exiting a sell trade because you quite frankly, in an upward trend, all you're allowed to think about is buying or exiting that buy trade. And you can see here, it all says enter buy, exit buy, enter buy, exit buy. That is all you want to be thinking about in an upward trend. When we roll over into a downward trend and we look at some downward trend examples shortly, you will see that that gets flipped around on its head. Now, what you will notice is, in an upward trend, we have what we call higher highs and higher lows. Ultimately, in an upward trend, everything should be getting higher. So we can see on here that we have these high points that get higher, so higher highs, and we have these low points that get higher, hence higher lows and higher lows. So higher highs, higher lows in an upward trend. Now, it looks nice and simple when you look at things in graphical format like this, but how do people get this wrong? Well, one of the easiest ways to get this wrong is to completely forget about 2 cycles. Remember, you've got to see 2 cycles in order to have a trend. 1 cycle's not enough. So 1 cycle there, too early, no good. Another way you can get this wrong is what we call cyclicity clueless traders. Now, the way that I tend to phrase this or showcase this is, all that really happened to these cyclicity clueless traders is they just zoomed in too much. Imagine if that's all you can see. If that's all you can see, you'd think the market's moving down. And that's the reason why we need to see 2 cycles to make sure we've actually got the big picture before we do anything else with it. So just zooming in at any one point in time is not good enough. We need 2 cycles first, and then we can get a bit more stuck into it. So there are a couple of ways. Other ways that you can muck this up is what we call social proof or emotional traders. Now, let's say, for example, Smart Charts gives you a trading signal and says, as of here, you should buy, you should place an entry level. It says you should place a stop loss. And let's say, for example, it says you should place a target around here. Now, that's what you should do. The trouble is, these emotional or social proof traders, they just want to wait and see a little bit longer. So they'll wait till price gets to around here somewhere and I'm still not 100% sure. So they'll just wait and see how it goes and a little bit longer. And now price is up here somewhere. And they're going, oh, it's not quite there yet. They're coming up with excuses all the time. Bearing in mind, Smart Chart said buy back over here somewhere. They're still sitting on their hands. They're still waiting. They're not taking action. Next thing you know, price gets up to here somewhere. And they realise now, oh, do you know what? I've probably missed this trade. But then their emotions take over even more. And they end up jumping into the trade around here. Now, the reason that happens is they're thinking, well, it's already gone up this far. Surely it's going to keep going a little bit further. And they go, whee, and get caught out. The fact of the matter is, these social proof emotional traders, they're getting into the trade as you should be getting out of the trade. So from that perspective, you can see straight away that you want to be trading at the beginning of phase 1 down here. This is where you want to be entering the trade when Smart Charts, the software, gives you the trading signal and tells you it's a good trading opportunity. And you'll be looking to take your profits somewhere towards the end of phase 1. It's difficult to get a perfect exit, but somewhere towards the end of phase 1, you'll be looking to exit the trade and then wait for the next phase 1 to repeat the process. But these social proofers, they just leave it far too late. Another way people get this wrong is they spray and pray or they hit and hope. They basically just button mash and just constantly hit buy and sell, hoping to try and capture every single little bit of market movement. The trouble is that just doesn't work. They're trying to get every single little bit of market movement and they're putting quantity ahead of quality. Quality over quantity is the important thing you should take away from this. It's the quality trades that make you money, and taking lots and lots and lots of trades only makes the broker money. At the end of the day, as traders, we only get paid from our positive trades. And our losing trades cost us money. It's not make money or break even, it's make money or lose. So if you aren't happy with a trade setup, walk away. Don't try and button mash and take every single trade. Just focus on quality over quantity. This is essentially what you're going to be focusing on doing, what you're trying to achieve. You want to be entering your trades at the beginning of phase 1. Now, you're never going to get the absolute beginning of phase 1, but you want to be, I would say, in the first quarter of phase 1. Now, you're not going to know it's the first quarter in real time until phase 1's actually happened. But when you're getting into a trade at the beginning of phase 1, it usually works out around that first quarter. And the blue line there corresponds to where your entry level is going to be. The red line is showing you your stop loss, and the green line is showing you your take profit or your target level. You'll come out of your trade and you'll bank your profits. Now, the good thing is when you place trades, you haven't got to be in front of the screen for long. You don't need to sit there for 4 hours at a time. You do something called placing an order. What you basically say is, if price gets to this level in X period of time, get me into the trade. Now, if it goes the wrong way, it goes the opposite way to the way I think, I'm going to put a stop loss there to protect myself and make sure that I only lose a known quantity of money. I don't want to lose all my money, just lose a small amount. We've then got our take profit. Our take profit sits up here, and that's our command or our instruction to the broker to say, look, when price gets to this level, that's as far as I think it's going to go. Take me out, bank my profit, and I can move on to the next trade. Now, we've looked at upward trends. Now it's time to have a look at what happens in a downward trend. It's essentially a mirror image along this axis here. So if you think about the upward trend got the phase 1 going up, something like this, and you can see the phase 2 was then going down. You understand that essentially this is a mirror image of the upward trend. We're now looking at a downward trend. Now, in this downward trend, we want to sell. Simple as that. You're not even allowed to think about buying anything here at all. You're just going to sell, sell, sell on the way down. Now, you'll notice that phase 1 is still going with the trend. But phase 1 went up last time because it was an upward trend. Phase 1 now goes down because we're in a downward trend. So, phase 1 with the trend again, phase 2 against the trend again. Now, looking at this now, we've got some different options. And we're going to do the practical that we did previously as well. And previously we looked at an upward trend, now we're going to be looking at the downward trend. Now, we've got numbers 1, 2, 3, 4 and 5. Your options are same as last time. You can choose to do nothing. You can choose to enter a buy trade. You can choose to exit a buy trade. You can choose to enter the sell trade. You can choose to exit the sell trade. Now, I'm going to help you out a little bit here because people tend to get a little bit confused with downward trends. So what I'm going to say is, just to help you out to begin with, is that we know in a downward trend, all we really want to do is sell. So you're primarily going to be focusing on selling on the way down. That means that entering a buy trade and exiting a buy trade are now out of the equation. So your options you've got left really are enter a sell trade, exit a sell trade, or if you're really not sure, then of course you can choose to do nothing as well. But go ahead now, pause the video, work out where you want to buy, where you want to sell, where you want to enter a sell trade, exit a sell trade, where you want to do nothing at 1, 2, 3, 4 and 5, and then hit play again when you want to see the answer. So go ahead now, pause the video, work it out for yourselves, and hit play again when you want to restart. So let's take a look at these answers now, what you're going to be doing in this downward trend. Now, on the way down here, you want to make sure that at position 1, you want to be entering a sell trade. So we're selling at 1. And keeping with that theme, we're also going to be entering a sell trade at 3 and entering a sell trade at 5. You'll notice that we're always selling high on the way down, so entering a sell trade. And of course, that means that at 2 and 4, they're going to be exiting those sell positions. So we enter the sell trade at 1, and we exit that sell trade at 2. A whole separate new sell trade at 3, and we're then exiting that sell trade again at 4. And again at 5, a whole separate sell trade or short position again at 5. And of course, if there was a 6, 6 would then be exiting that sell position or exiting that short position again. Now, you'll notice on the way down, we have those lower highs now, and we have lower lows. So very simply, we can see the highs are getting lower, and the lows are getting lower. And on a downward trend, that's exactly what you should have, lower highs and lower lows. Now, what I'd like you to do now is highlight the counter trend or cyclicity clueless traders. The other way of thinking about this, think about the people that zoom into the screen too much. So you can see that there's the 1, 2, 3, 4, 5, and there's also phase 1 and phase 2. Just think about where these counter trend or cyclicity clueless traders are. Think about where they try and trade, and then normally zoomed in too much. So go ahead, pause the video, and try and work out for yourself where these cyclicity clueless traders are going to be. And of course, these cyclicity clueless traders, they're going to be trading through this area here. They're going to be trading the phase 2s. Remember, they're zoomed in far too much. So they're essentially going to be trading these phase 2s. Now, we of course don't want to do that, but that's what the cyclicity clueless or too zoomed in traders try to do. Looking at the next practical, highlight or think about the emotional or social proof traders. Where do they try and trade? So where do these emotional social proof traders try and trade? Go ahead, pause the video, and when you think you've got it right, restart the video again and check the answers. And of course, these emotional social proof traders, well, they're trading at the end of phase 1. Remember, what these emotional social proof traders do is that they see the trade set up. So the software says, yep, there's a sell signal somewhere around there, and they wait and they wait and they wait and they wait and they wait, and they jump in at the end of phase 1. So that again is something you don't want to be doing. Now, what I'd like you to do is draw 2 cycles for both uptrend and for downtrend, just to confirm that you know exactly what an upward trend should look like, and of course what a downward trend should look like. Once you've drawn your 2 cycles for uptrend and of course for downtrend as well, just put little arrows where you'd like to enter buy trades, exit sell trades, enter sell trades, do nothing. You understand what I'm saying. Enter buy, enter sell, exit sell. Draw a couple of cycles going up, a couple of cycles going down, and what you want to do at each of those points. Go ahead, pause the video now, do that, and come back again when you want to check the answer. Okay, so looking at the upward trend to begin with, we know that when we're looking at upward trends, we have phase 1, we have phase 2, we have phase 1, and we have phase 2. Now thinking about where we want to buy, where we want to sell, because this is an upward trend, we don't want to sell anywhere. Now if we assume that the market is already trending, then we'd enter a buy trade, and we'd enter the buy trade. And we'd be exiting our buy trades up here. If we hadn't got 2 cycles, we'd do it slightly differently. So let's do the same thing again now, but assuming we haven't got 2 cycles, and let's assume these are the first 2 cycles. If these are the first 2 cycles, we'd actually do nothing, 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 nothing. But here at the end, that's where we'd be entering our buy trade. So the difference there is, if we've got 2 cycles and you're already trending, then we get straight into that trend and trade it. If we're not trending yet and we haven't got 2 cycles, you need to wait for those 2 cycles before you can start trading. So that's all for the upward trend. If we now take a look at a downward trend, so now we're looking at phase 1 moving down, and we get ourselves a phase 2 pullback, phase 1 moving down again, and again a phase 2 pullback. We can see that phase 1 is longer than phase 2, as it normally is. And on the way down here, if the market's already trending, we'd enter a sell trade and we'd exit. We'd enter the sell trade and we'd exit. And at the end here, we'd also enter a sell trade as well. Just as before, if we hadn't got 2 cycles yet, if these are your first 2 cycles, we'd need to actually wait for them to happen before we could do anything. So if these were your first 2 cycles, you'd only really be selling at the very end here. Remember, those 2 cycles are really important to make sure you don't get caught out in a sideways marketplace. So in summary, we trade trends. We buy in upward trends, we sell in downward trends. How do we know if the market's trending? We make sure we have at least 2 cycles to determine trend. When we're buying on the way up, in an upward trend, we want to be buying low and then exiting higher up. On the way down in a downward trend, we want to be selling high and exiting lower down. And smart charts will do that for you. It's just nice to know that you understand what's going on in the background. In this module, we're going to be looking at moving averages. Now, moving averages are really useful to help you with the direction the market's moving. They work really well alongside cyclicity. They help you with which direction you want to be looking at in order to work out your cycles. Now, moving averages are a lot easier for you to use than cycles, and it's pretty much the first thing you're going to be looking at when you get to the screens. Now, here we have a basic chart on Smart Charts, and we can see on the chart here that we have 2 wavy lines running through the chart. You've got this blue line here that I'm drawing over now. And we've also got ourselves this gold line. And both of those are what we call moving averages. Now, you can see that the price reacts off of moving averages, and in a trending marketplace, it typically bounces, 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 and so on. And we can use this to our favour. But moving averages help us to work out direction and also help us to work out where the next bounce is likely to occur. Now, what on earth is a moving average? How's it calculated and all that stuff? Well, moving averages are used to tell us, on average, whether price is moving up or down. They don't tell us what's going to happen next. They tell us what's likely to happen next. Nothing's guaranteed after all. Now, we don't know the maths. We don't need to know the maths behind the moving averages because the smart chart software is going to draw it all for us. However, you do need to know which type of moving averages we're going to be using. Now, a simple average would just be to add up the last, 20 bars, for example, and divide by 20. But that's not what we do. We use something called EMAs, exponential moving averages. Now, the biggest difference between EMAs, exponential moving averages, and anything else is the way that they average out the data. Now, essentially, what an exponential moving average does, it says that the more recent data is more important than the older data. So it doesn't treat all data fairly. It says the more recent stuff is far more important than anything else, whereas a normal average treats everything equally. So these react really fast, right up to date with the current price. Now, moving averages are simply an average of the last X number of bars, but as we said, the exponential moving averages are going to put more emphasis on these and less emphasis on these, which means that the moving average is going to react a lot faster for you. Now, I mentioned the 20 moving average previously, or the last 20 bars, and that's exactly what the 20 EMA is. It's an average of the last 20 bars on the chart. It's one of the main moving averages that we use, and it gives us a good indication as to where the market's been, currently is, and is likely to go next. Now, we use two moving averages because it helps us with direction. We use the 8 moving average and we use the 20 moving average. Now, you can probably tell by these colours here straight away that with the 20 moving average being drawn in blue and the 8 moving average is kind of in a gold yellow colour there as well. Now, we refer to the 20 moving average as being the slow moving average. It's the slower of the two. It takes more time to move because it's looking at more bars. Then when we look at the 8 moving average, we refer to that as being the fast moving average. Because there's less bars being averaged, it moves faster. So fast, slow moving average, 8 moving average is fast, 20 moving average is slow. And smart charts will draw them in that gold yellowy colour and also the blue as well. Now, if we take a look at a chart and understand what's really going on here, when the 8 moving average is above the 20 moving average, all you're thinking about doing is going long. All you want to do is buy. Now, let's just point out the 8 moving average and the 20 moving average. Well, we've got the 20 moving average here, which is in blue, and you can see it's drawn on the chart. And we've also got ourselves that 8 moving average as well. And when the 8 moving average is above the 20, that tells us upward trend. All we want to be doing here is buying. Now, that's great in the upward trend, but what you're going to notice is, in the downward trend, they're going to change around. So in the downward trend now, when the 8 moving average, and we'll just draw that on so you can see it, when the 8 moving average here, when that's underneath the 20 moving average, that tells us the market's currently moving down and is likely to keep moving down. And you can see, I've only drawn halfway deliberately, but you can see that that tends to carry on into the future as well. So when the 8's beneath the 20, all you're thinking about doing is selling. Now, that might seem quite simple to begin with. 8 above 20 you want to buy, 8 below 20 you want to sell. But we've got 3 different types of market condition. We've got sideways markets as well. So when the market is sideways, like this for example, I mean you can't really miss it. When the market is sideways like that, we quite simply want to leave it alone. We don't want to touch it at all, because that's somewhere that you go to lose money rather than make money. Now, we can see here, this is basically a bit of a summary for us, saying that if the 8 moving average is above the 20 moving average, long only. Long, of course, meaning buy. So 8 moving average above 20 moving average, that's when we want to be buying. And 8 moving average below the 20, that's when we want to be selling. Of course, if the market is sideways, leave it alone. In this module, we're going to be taking a look at some advanced price action patterns. We're going to be carrying on from where we were earlier with the price action section and going into more detail to show you advanced patterns that signal the change of phase in the markets so you can make consistent profits out of the forex marketplace. Now, all of these advanced price action patterns are designed to trade phase 1. So we're looking for the change in phase in the direction of the trend. So overall upward trend, we want to be buying, we're looking at the change into phase 1. And these price action patterns will work more often than not. They give you a good level of success, and they're something that you should be using as part of your trading on a regular basis. Now, there's actually 4 patterns. The 4 patterns are called ringed lows, ringed highs, low test bars, and high test bars. The first one we're looking at is called a ringed low formation. Now, it's important to note that this ringed low formation is what we call a multi-bar pattern. Basically, multiple bars are used to create the pattern. It's not too complex. Now, there's 2 different stages of these. There's what we call a potential ringed low and a triggered or a confirmed ringed low. Essentially, we want to be there on a potential ringed low. Because if you get there for the triggered or the confirmed one, you've already missed it. You're too late. So we're looking for a 2-bar pattern, a potential ringed low pattern. Now what it is, essentially, first of all, bar 1 can be absolutely anything. Red, green, black, white, purple, yellow, short, tall, fat, thin, doesn't matter. Bar 1 is absolutely anything. And before you start getting scared about writing notes down, don't worry, I've got this on the next slide for you as well. But first bar, anything. Now, the second bar needs to have 2 things happen. The second bar needs to have a lower high than the previous bar, and it needs to have a lower low than the previous bar. So lower high and lower low. Simple as that. That's all we need to see. Now, you'll notice with looking at this, I've deliberately not drawn any of the opens or any of the closes on the bars at all. And that's because, quite frankly, when it comes to ringed lows, they just don't matter. All we're looking at is the high and the low of the bar. So bar 1, anything. Bar 2 needs to have lower high, lower low. Great. So there's your bar 1, there's your bar 2. And the reason why we don't want to see these triggered or confirmed ones, because we've missed them, is because bar 3 should then move higher than bar 2. Now, we place our orders at the end of bar 2, assuming that bar 3 is going to go up. If bar 3 does not go up, you don't lose anything, don't worry. But you don't make anything either, because we're doing something called a conditional entry. We're saying if bar 3 goes up, great, get me into the trade. But if bar 3 doesn't go up and bar 3 goes down, you just quite simply won't be in the trade. So you can't make or lose anything. You just stay flat or break even. No win or no loss. Now, if we look at that in a bit more texty now so you can see it, you'll see bar 1, absolutely any type of bar. So first of all, just labeling that for you. Bar 1, absolutely anything. Bar 2 must have a lower high. Well, if that's bar 1, next bar has the lower high. Okay, that's the first thing. And it must also have a lower low. So bar 2, low, lower low. So now that we're happy that we've got bar 2 and we've located bar 2, we place our entry order just above bar 2 with our stop loss underneath bar 2, and we'll have a target up here somewhere as well, a take profit up there somewhere. The idea is now we're assuming bar 3 is going to go up and start the new phase. So we're expecting this to happen in a big way in our direction. If that happens, we get triggered into the trade. And now that we're in the trade, we've got a target, we've got a stop loss. It's either going to win or it's going to lose. So that's essentially what we're looking for with a ring to low pattern. Now, it's one thing seeing it in a pretty picture here, but you need to also see it on charts as well and understand the context as to when we're going to be using it. So the ring to low pattern is only used in an upward trend. If you use ring to lows in a downward trend, that's a great way to lose a lot of money very quickly. So ring to lows, uptrend, they're a buy signal. Now, while we're talking about these ring to lows in this price action patterns section, it's important to note that these ring to lows will feature in one of the trading systems that you'll see in a different module. So the 180 profit booster, which is one of the 4 trading systems, well, that's going to use ring to lows, and the next thing we look at, which is ringed highs. So you'll be seeing these in a different module again later on. Now, as we look at an upward trend, this is with an 8 moving average, and we have a 20 moving average, a lovely upward trend through there. And we've got some different coloured arrows here, and I kind of want to make sure you understand why they're there. Now, the red arrows for both this slide and the coming slides as well will show you potential signals. And potential signals are that 2-bar pattern. Now, every single confirmed signal will have been a potential signal. Just say that again. Every single confirmed signal will have had to have been a potential signal first of all. So every single one of these that's got an arrow will have that formation there. Now, why is it we've got one red one and several blue ones? Well, the blue arrows here are showing the confirmed trades. So you actually have the 3rd bar doing what we expect to happen. Now, if we zoom in and look at some of these in more detail so you can really see what's going on. If I zoom into the first one down here to begin with, and we are going to be focusing on a potential and a confirmed side by side here so we can see why one has triggered and why one hasn't. So let's just have a look to begin with and assume that this bar here is bar 1. And that's exactly what the computer does. It assumes every single bar is bar 1. We've just started a little bit later in the chart. Now, if that's bar 1, the next bar, in order to be, should we say, classified as bar 2, needs to have a lower high and it needs to have a lower low. And that would be a potential signal. So lower high, yep, definitely got that. Lower low, yep, definitely got that as well. Therefore, this is bar 2. Now that we've got that, we're expecting bar 3 to push up aggressively in our favour. And the trouble is, what happens here is with bar 3 doesn't go higher than bar 2. Now, let me just draw this on so that you can see, but your entry level would have been around here. I think you can see the problem here is that bar 3 doesn't get to your entry level. So as a result, you wouldn't have got into the trade. Therefore, that's what we say is a potential signal, but it just never got confirmed. That's hopefully easy enough to understand on that first one. Okay, because bar 3 did not go above bar 2. Now, if we move on to have a looking at this blue arrow next to it and just working through this one, why is that one being an arrow? Well, I'm actually going to work through this bar by bar by bar for you so you can see what the computer's doing and what you're going to be doing. Now, you may have to watch this several times to fully understand it because it's quite a in-depth subject, but let's zoom in so you can see. So, the last time we said that this one here was bar 1 and this one here was bar 2. Well, now we're going to assume that this is bar 1. So the computer assumes every single bar is bar 1. We're going to work in exactly the same manner. Well, lower high, but a higher low, that's no good. For a potential signal, we need to see the lower high and we need to see the lower low. We haven't got that there, so that cannot be bar 2. Therefore, it must be bar 1. So, there's bar 1 for us again. Now, if that's bar 1 for us there, lower high, lower low. Great. We've now got ourselves bar number 2. Now, with bar number 2 here, we'd be placing our entry level above this. We'd be placing our stop loss level underneath this. So you can see our entry and our stop goes either side of that bar 2, and our target would be up here somewhere. Now, you can see the next bar, which happens to be a green bar, goes a little bit higher than bar 2. And that means that bar 3 here, that's now gone higher than bar 2, means that you've been triggered into the trade, and you can expect for price to keep moving in your favour to the upside. And you'll see, as I've been drawing, while that's the potential signal, the confirmed signal is actually that completed 3-bar pattern where you have bar 1, bar 2, but bar 3 going higher than bar 2. And we can see that down here, bar 1, bar 2, 3 going higher than 2. There's your pattern. Right, so that's the first one. That's the ringed low pattern there. And we've been through a couple of examples so you can see what a potential one looks like and what a confirmed one looks like. If you look at the rest of these signals as well, they all will have been potentials with a 2-bar pattern, lower high, lower low, but also then confirmed by this move up. Okay, if you could please now download the Advanced Price Action Exercise PDF, you'll be able to follow along and participate in some of the practicals we're going to go through next. Okay, so on this chart we've got ourselves an upward trend. We can see the price action and we can also see the 8 and the 20 moving averages on there as well. Now, on this chart there's 16 ringed lows that are what we call potential signals. Now, those potentials are going to look like this. They're going to be that 2-bar pattern where bar 1 is absolutely anything, bar 2 is the lower high and the lower low. Work your way through this chart and try and find all 16 potential signals, and pause the video now and do that, and when you're ready to start again, hit the play button and I'll go through the answers with you. Okay, so there's 16 potential ringed lows on this chart. So if we start off looking at the first one, we can see here now, bottom left-hand corner of the screen, if I just zoom into that to give you a better perspective as to what's going on, why is that a potential ringed low? It's a potential ringed low because we have a lower high and a lower low from bar 1 to bar 2. And that's the reason why it's a potential signal. Now, as we look at the next signal we have over here, it's again because of the lower high and lower low. And zooming in once more so you can see clearly, we have that lower high and we have the lower low. That means it's a potential ringed low and you'd be placing your orders above that bar. As we continue through, these are the answers so that you can see them. These are all of the potential ringed lows, all 16 of them on this chart. Now, if you found all 16, well done. Now it's time for you to go through those 16 and find out which 7 of those actually trigger. Now, what does a triggered trade look like compared to a potential? Well, the potential ones that you're already drawn on here for you, we already know are a 2-bar pattern. But the triggered trades, the confirmed ones, are going to have bar 3 moving higher than bar 2. There's 7 of them on the chart. Have a look now, pause the video, see if you can find them. Alright, time to look at the answers. So, on this chart here, I've got the potentials that have remained potentials, but just focusing on the ones that have actually triggered, these are all of the triggered trades on the chart. Now, why are these all triggered trades? Let's start off with the first one and go into some detail so you can see. Now, with this first confirmed signal, we can see the potential, lower high and lower low. So absolutely, this would be our bar 1, and this would be our bar 2. Great. Now that we've got the bar 1 and the bar 2, we'd have placed our order above bar 2, and we can see that bar 3 here would have gone above bar 2 and triggered you into your trade. Therefore, we have ourselves a confirmed signal. And looking at the next one, we can see here as well, this would be a bar 1, the lower high and the lower low. This would be our bar 2. We'd place our entry level above, and we can see bar 3 goes above bar 2. We'd now be in the trade. And there, 1, 2, 3, 4, 5, 6, 7, there's your 7 confirmed or triggered trades on the chart. Now, ringed lows are great, but we also need to think about what's going to happen in a downward trend. So, ringed lows are for the upward trend, but these ringed highs now are the mirror image for a downtrend. They work in a very similar way, but they're just quite simply flipped over for being a mirror image. Now, just as before, bar 1 is absolutely anything. So this bar here, bar 1, absolutely anything at all. Short, tall, fat, thin, red, green, yellow, doesn't matter what colour it is, it's any bar at all. Now, for the potential signal, bar 2 needs to have the higher high and also a higher low. And if we've got that higher high and we've got that higher low, that's what we call a potential ringed high pattern. Because what we're expecting to happen next, we're expecting bar 3 to then move aggressively to the downside in our favour. And we can see on the right hand side of the screen here, we can see the bar 1, we can see the bar 2, and the idea is you place your order at the end of bar 2 and bar 3 triggers your order and it becomes a trade. So that's what we're looking at, talking you through it. And so that you can see it in more of a texty way, we can see here bar 1, absolutely any type of bar that you like. Bar 2 has got to have that higher high and higher low, and that's the potential signal. And bar 3 must then move lower than bar 2 for it to be a confirmed or a triggered trade. Now, we use these only in a downward trend. We don't use ringed highs in an upward trend at all. Ringed highs give us good points to sell in a falling marketplace. So they're a sell signal in a downward trend. Now, as I mentioned earlier, the 180 profit booster, which is one of the 4 trading systems, that's going to use these ringed highs and the ringed lows that we just looked at. And these are a great sell signal for a downward trend, and the ringed lows we already know are a great buy signal in the uptrend. Now, as we look at a chart, this gives us the examples here. So we can see there's 6 arrows there, and those 6 show us the signals that we could have taken in a falling marketplace. Now, so that you can see why they're the ringed highs, if I just zoom into a couple of these. If we look at this second blue arrow from the left-hand side, where we've got this green, red, red, and just have a look at those, the colour of the bar doesn't matter at all. It's completely irrelevant, in fact. But if we actually delve into what's going on there and call this one bar 1, we know after bar 1 to see bar 2, we'd need to have a higher high and a higher low. And that's exactly what we've got. We can see there, higher high, higher low. We've got ourselves the potential pattern. And if I just draw it on so you can see, there's your higher low, there's your higher high, there's your potential pattern. And we're assuming bar 3 then goes lower than bar 2, which is exactly what happens. Same thing happens over here. Here's your bar 1, higher high, higher low. There's your bar 2. You place your entry order to sell underneath this bar now, and sure enough, bar 3 goes down, lower than bar 2, and of course you'd be in the trade and you'd be very happy with the result. Now, time for you to have a go at a similar thing. So, on this chart, there are 14 ringed highs that are potentials. What I'd like you to do is go to the chart, try and find all 14 and mark them on your workbook so you can see. Mark all 14 now, pause the video, and when you're ready, hit the play button again. Okay, so it's time for the answers. So, with these 14 potential ringed highs, these are all of the patterns on the downward trend. Now, looking at all of these on the downward trend, we can see there's lots of different signals that are going to be generated. Now, every single one of these will have been bar 1, absolutely anything, and bar 2 with the higher high and the higher low. That's the pattern that will have been in play on every single one of these. If we go and look at the first 2 just to give you an idea so that you can see. Zoom in a bit more. We've got bar 1 down here. That's the green bar. Again, colour doesn't matter, but it's the easy way for you to see it. Higher high, higher low. Therefore, we're looking now at bar 2. Great, we've found bar 2. We would then place our entry order to sell underneath bar 2, and sure enough, bar 3 goes lower than bar 2, but all we needed to see here was the potential signal. I've helped you out with one of the answers for the next question. But there's your potential signal, and similarly here, a potential signal again. The higher high and the higher low. So long as you've got that, you've got a potential signal, and when bar 3 goes lower than bar 2, it's confirmed. Now, every single signal on the chart will be potential, and some of them get triggered. Now, on this chart here, 10 of those potentials get triggered. Take a few minutes, look through the chart, and try and find out which ones get triggered and mark them. Pause this video now, go ahead and do that, and hit the play button when you're ready to get started again. Okay, so looking now at these 10 that have actually been valid signals, we can see the one that I pointed out initially for you to get you started. We've then got the second signal there as well. And the reason why we've got these are because the third bar goes lower than the second bar. So very simply, we knew it was a potential signal already, and bar 3 went lower than bar 2. That was all that we were looking for. And you'll see as we progress through here, these are all the different signals on that chart, and you can see there are quite a few of them. So in a trending marketplace, you're not just looking at one or two signals, you're going to be looking at several high quality signals back to back. Now, we're not just going to be using ringed highs and ringed lows. Sometimes a ringed high and a ringed low aren't going to give you a signal, whereas these next two patterns we're going to be looking at will give you a signal. Now, the next two patterns we're looking at are called low test bars and high test bars. And, well, what's the difference? Well, they're a single bar pattern now. They're not that multi-bar pattern of several bars side by side. Now it's just one bar telling us what's likely to happen next. Now, a low test bar is called a low test bar because price has tested the lows and been rejected. Now, it tells you here in the middle of the screen, a low test bar means price is likely to move up. Not guaranteed to, but it's very likely to. In fact, when you're looking at these test bars, both the low test bars and the high test bars, you'll find that test bars tend to give you a slightly better quality signal compared to the ringed lows and the ringed highs. So these low test bars and high test bars, they're not as frequent as the ringed lows and the ringed highs, but they do tend to give you a better quality signal. Now, low test bars, price is likely to move up. What does it look like? Well, the colour, once again, completely irrelevant. Green, red, doesn't matter at all. So that's the first thing. It doesn't really matter at all what the colour is. Also, it's just one bar that's telling us what could happen next. Now, toward the bottom middle of the screen now, you'll see some text here that really is going into detail as to what you need to see. So, regardless of colour, that's the first thing. Open and close, that's the little knob on the left, open, and the close, need to be in the upper half of the bar. Well, quite conveniently, we've got the upper half shaded in so we can see, and it's pretty obvious on both the red and the green low test bars, open and close are in the upper half of the bar. Great, happy with that to begin with. Now, the next part is usually what catches people out and usually what confuses people. So just make sure you understand this clearly. Either the open or the close in the upper third. Now, if I draw a third line on just so we can see, looking at this, either the open or the close, or in fact, both of them in fact, could be in the upper third. But at least one of them needs to be in the upper third. Now, looking at this, we can clearly see both the open and the close in the upper third of the bar. And that's what makes this into a low test bar. If we look at the green low test bar on the right-hand side of the screen now, sticking with exactly the same rules, open and close, upper half of the bar, absolutely happy with that. And looking at this bottom part now, either the open or the close, or both of them, in the upper third. Now, it's pretty obvious to me looking at this closing price, that's definitely in the upper third of the bar. As a result, we don't even need to look any further, because they're both in the upper half, with at least one in the upper third, we've got all conditions correct, that makes it a low test bar. Great, I hear you say, but what does that really do for us? Well, it tells us there's a very good chance now that price is likely to go up. Now, what's the easiest way to imagine this? The easiest way to think about this really is looking at this screen here. You can see I've got a tennis ball. Imagine throwing a tennis ball against the floor. If you throw a tennis ball as hard as you can against the floor, it's not going to go through the floor. It's not going to stay on the floor. It's going to bounce, isn't it? Fairly obvious. But when it bounces off the floor, it's not going to go up forever. So it's only a short-term change in momentum, and that's what you really need to be aware of. For all of these price action patterns, they're just a short-term shift in momentum. And looking at this low test bar, it's like throwing a tennis ball against the floor, it hits the floor, bounces back up again, and that's exactly what's happening inside this bar. Price gets thrown down, 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 down towards the floor, hits the short-term floor in the market, and is now getting thrown back up again. Again, it's not going to go up forever, but as a short-term shift in momentum, we're expecting that to continue to the upside. Now, when do we use these low test bars? Well, we use them in a similar scenario to the ringed lows. Low test bars are a buy signal. We only use them in an upward trend. So upward trend, if you get a low test bar, you've got a buy signal. Simple as that. Now, you'll see there's some black text there on the screen that says income wave will use low test and high test bars. And that's completely correct. Now, the income wave is one of those four systems. And the income wave will be using low test bars and high test bars to get you into the marketplace. So now you're understanding some of the background as to what's going in to some of these trading systems. But this is a strong, high probability system for giving you a signal that the market's likely to go up. And if we look at an upward trend so that you can see, I've got some low test bars marked for you. And while they all happen to be green on the chart, they didn't need to be green. They could have been any color. It's just the way it happens to be through here. But on all of these, I mean, the obvious one there to look at to begin with, open and close in the upper half of the bar, and open or close, or both of them, in the upper third. So there's your low test bar. Now, we're no longer looking at a multi-bar pattern, it's just a single bar pattern, so that on its own is enough to say market is likely to rally and move to the upside. Now, low test bars are for the upward trend. High test bars are the exact opposite, they're the mirror image now for a downward trend. So, price is likely to move down, high test bars are a sell signal, we only use them in a downward trend. Colour, completely irrelevant, doesn't matter at all. Pink and purple, doesn't matter at all, it's completely irrelevant. The important point is open and close have got to be in the lower part of that bar. So here's the lower half, it's all nicely shaded in grey for you, and it's pretty obvious here, the opening price and the closing price in the lower half of the bar. And we also need to have either the open or the close, or both of them, in the lower third. And the obvious part here is, well, the close on this bar is obviously in the lower third of the bar, therefore it's a high test bar. Why is it called a high test? Because it's tested the highs and it's not going any further up, it's now being pushed to the downside. And looking at this green high test bar, open and close so that you can see them. It's not the close this time that's the obvious one, but it's the open in fact. We can see the open and close in the lower half, and it's the open that's in the lower third. That tells us price is likely to move to the downside. Now, looking at that and talking about tennis balls again, imagine you're throwing a tennis ball against the ceiling. Now, you're not going to go and throw the tennis ball through the ceiling, it's going to bounce off of it. And that's exactly the mirror image of the low test bar. It's not bouncing off the floor now, it's bouncing off the ceiling. And again, it's a short-term shift in momentum. You're not going to bounce it off the ceiling and have it go down forever. It's going to bounce off the short-term ceiling until it hits the next short-term floor. So it's a move to the downside. And we use these high test bars in that downward trend. Income wave, one of those four trading systems again, is going to use high test bars on the way down, just like this chart here. And as I explained previously, it's going to use the low test bars in the upward trend for a buy signal. Now here we are looking at a chart again. This is actually a chart that you will have seen earlier looking at the ringed highs, but this chart now is looking at the high test bars. So you'll notice there's nowhere near as many arrows as we had previously. These are a lot more selective. So really the point for you to remember with these test bars, both high and low test bars, they are less frequent than the ringed lows and the ringed highs, but they are what we'd call better quality. It's a better quality signal. It's quality over quantity. So better quality, but fewer of them, of course. Now, here we've got a side-by-side standing comparison of these two. We've got the low test bars on the way up, and we've got the high test bars on the way down. So you can see the correct scenario for you to be using them. Now, this is quite good for you to look at because on the way up here in this upward trend, these aren't just low test bars. In fact, if we zoom in and look at these, you should be starting to tell that high, lower high, low, lower low, we've actually got a ringed low formation there. There's the potential ringed low, and there's the confirmed one. So we can see that that's actually a ringed low formation, and similarly up here, lower high, lower low, that's a ringed low as well. So sometimes there's going to be some overlap between low test bars and ringed lows. And if there's some overlap on low test bars and ringed lows, then occasionally there's going to be overlap on high test bars and ringed highs. Higher high, higher low. Same as this one, higher high, higher low. And you can obviously tell that one's an easy one to spot as a high test bar. But again, sometimes there's going to be overlap between the two. Great, it's giving you an even stronger signal. So in summary, 4 price action patterns. Ringed lows, ringed highs, low test bars, high test bars. Ringed lows and ringed highs are more frequent, and they're a multi-bar pattern. Low test bars and high test bars have got a better success rate, but they're less frequent. There's not as many of them. You can use both or all 4 signals to make money, but we only use the low test and the ringed low in the upward trend, and high test or ringed high in a downward trend. When Smart Charts loads up, this is the screen that you're going to be looking at. It's called the Trade Ideas Scanner. Not some confusing chart that you'd normally look at on other charting systems with indicators all over the place. This scans the market for you and tells you what's setting up right now in a simple traffic light system from red to amber to green and green flashing. No more running through 14 different charts, looking at them all, trying to find a trade. Smart Charts does all the hard work for you and brings it down to a couple of simple clicks of a button. In this scanner, you're going to see 4 columns. These columns have got the names of the 4 trading systems at the top of each one. We're starting off on the left with the 180 profit booster. Then you've got the income wave. We've also got the interbank radar and the money market breakout. And we can see there's a different color-coded system for each of these 4. Because what's happening is Smart Charts is scanning all those different currencies for those different systems, telling you what's setting up on that system right now. For example, if we take a look at the 180 profit booster, we can see that several of these are flashing in green. We've also got just solid green underneath. We've got the yellow color and the red. Now red very simply means no trade. There's nothing there, don't bother even thinking about looking at it. We then got this yellow, and the yellow or the amber means wait. Some of the things are setting up, but it's not quite there yet. Green means get ready. Almost everything's set up, it's almost there, it's almost good to go. And finally, perhaps the most important one, we've got the green flashing. Green flashing means go and have a look, everything's setting up, it's good to go. All you need to do, quite simply, is left click on one of the green flashing symbols and you'll be able to go and look at that chart. It'll load up into the correct screen on the correct time frame on the correct symbol, telling you exactly what is setting up in the marketplace right now. We can see here we've got the sell button and we've got another sell button. It's deliberately there so you cannot push the wrong button at the wrong time. So there's no buy button there because this is a downwards marketplace. Now, between the sell and the sell at market, we always choose the sell button here. It's in bigger text so you can see it more easily. That's the button that you want to push. When you push that button, what's going to happen is Smart Charts is going to work out which direction you want to be trading on that trading system, work out what a 1% risk is, which no other charting system does this. It keeps it incredibly simple and keeps your risk to 1% of your account. It works out what the volume is, and it also knows the entry, stop loss, and the take profit for that trading system. And it tells you the important stuff like the money that you could lose or the money you could gain based on that one particular trade. As soon as you click OK, the order's placed, the order's executed. Now, what you'll be able to see on the screen here now is we have got ourselves an entry level, we've got ourselves a stop loss level, and we've got ourselves a target or take profit level. Now, what do all those lines actually mean? The line here that says sell stop that I've highlighted over in blue, that's the level where you're going to be selling from. What it's saying is if price comes down to that level, that's where your order is going to get executed. Now, once your order gets executed, then you've got your stop loss and you've got your take profit to look after you. If the trade's going in the wrong direction, rather than taking a big losing trade, the stop loss is there to keep your risk small. And your take profit is here so that as the trade goes in the right direction, as soon as price gets to that level, you'll be taking out the trade for a profit. You haven't got to be there in front of the screen waiting for the price to get to those levels. You can walk away, do your own thing. So long as you've got the order placed, the computer and Smart Charts will take care of it for you. If you want to try and increase your gains or reduce your risk, you can actually drag your take profit and you can drag your stop loss on the screen. For example, if I want to move my take profit, my target, a little bit further and make a bit more money out of this trade, simply by left clicking, holding and dragging, I can now move my take profit to a lower level now so I can make more money out of the trade. And if I think there's too much risk on this one trade, I can reduce my risk by moving my stop loss. All of this allows you, at the click of a button, to put the odds in your favour. Okay, so now that we've placed that trade, let's take a look at it in the trade terminal. Now, the trade terminal is where you go to see the status of your orders and your trades on your account. We can see here that I've placed a 180 profit booster on the 4-hour chart. Now, the great thing about this is it's literally an all-in-one platform. So as soon as I place the order is executed on Smart Charts and my Capital Index brokerage account. They're linked together, so as soon as you push a button inside Smart Charts, it'll of course be replicated onto your Capital Index live trading accounts. So we can see here I've placed a 180 profit booster on the Euro US dollar, and it's what we call a sell stop. Now, that means I've placed an order saying if price goes down to a certain level, get me into the trade. What's quite neat about this is if price doesn't get down to a certain level that we expect, it's not going to get triggered into the trade. So it'll automatically cancel the order if price moves in the opposite direction. Now, if price moves in the direction you expect, you then be triggered into the trade. And that's when you'd see your net profit and your pips start to highlight and show up in different colours. If you're making money, which is the idea, they'd go into green with a plus symbol in front. And if you're temporarily in a losing position, it'd be red with a minus in front. So this trade terminal is the place that you come to once you've placed your orders, you've placed your trades. This is where you come to see how everything's doing and where everything's at. As you place more and more pending orders and some of those orders become live trades, this is your one-stop shop so you can see exactly what's going on with your current trades in your account. Now let's take a look at the Smart Charts Connect area. The Connect area is like the home page of a website. We've got the journal, the tutorial, the coaches section, we've got the Trader TV section, economic calendar, and also the news section as well. Let's take a look at the journal feature first of all.
This is the journal area of Smart Charts. I'm currently in the overview section where we can see the account balance, the floating profit and loss on the account, and some more stats like the closed profit on the account type, percentage success rate, how many pips have been made or lost on the account, average sized winning and losing trades. And scrolling down a bit further here, we can also see the total return on the account, average monthly return on the account, average weekly return, best week, best month, worst week, worst month, consecutive number of winning trades, and consecutive number of losing trades. Now, this is really good because we can ultimately see where we're making and where we're losing our money, and we can see our percentage success rate overall. There's a nice equity curve here that gets built showing you your account performance over time. And you can also check out your winning trades by symbol, winning percentage by symbol. You can see which systems you're favoring. And a bit further down, we can see which days of the week that you're making and losing money as well. Now, this is just the overview section where Smart Charts gives you an idea as to as it says, an overview as to what's going on with your accounts. But we can then go into a step more detail and see exactly where you're making your money and exactly where you're losing your money in the analysis section. In this analysis section now, we can see exactly where the account's making and losing money. We can see it based on the percentage return. We can see the number of orders that have been placed there. We can see the gross profit, gross loss, and the net profit of the trading system alongside the success rate. Now, I've deliberately logged into a different account now so that we can see winning and losing trades. I just don't want to show you all winners all the time. But you can see through here, if a client had traded this income wave 4.64% up over 7 trades, great, they're making money, but it's not really enough trades yet to be a fair sample size. Similarly, you'll see on the one above there, the precision power play. Looks like there's been 7 losing trades from 7 trades. Obviously, there's been something going wrong there. Time to stop trading that, take it back to the drawing board and work it out before they keep going live. So this really gives you a lot of detail so you can work out where you're making and where you're losing your money. And it's really, really important because when you're making money, you want to keep doing it. And if you're losing money on a certain system, you could be doing something wrong. You can take it off onto a demo account. You can practice there while you're still live trading on your profitable systems. Bearing in mind, looking at this here, I'd say that there's only really 2 systems that are suitable. I'd say the money market breakout here, 6.37% return from 41 trades, good sample size, ahead overall. It looks like making money consistently on that system. And looking at the power trade here at the bottom, a 3% gain from 13 trades. Ideally, I'd like to see 20 trades there, but it's the second highest in the list. Behind there, we can see we've got this interbank radar on 180. They've had so few trades, it's just been a case of a couple of wins, a couple of losses. And as we look through the rest of the system, the income wave up there with 7 trades, yes, looks like making money, but I'd need to see more stats to really have an idea as to what's going on. And that's the really good thing with Smart Charts, is that you can highlight exactly where you're making your money, exactly where you're losing money, so that you know where to focus on. Now, as you scroll down further through this analysis section, we can see which trading strategies are making the money. We can see which trading symbols are making the money as well. And our whole heat map is then created so that you can see where you're making and where you're losing your money and how many trades you've taken there on that system for the percentage gain or the percentage loss. And this is really, really useful. And we can also see if you've been breaking rules, because you may have some trades that are slightly less than 1% targets, like this gold trade here, for example. We can see where you've perhaps broken your rules slightly. And this is a really, really good section for coaches to be able to work out what you're perhaps doing well, but also what you're perhaps doing not so well. We've also then got a whole closed order section here. And we can see the winning and losing trades on the accounts. And we can obviously see the green wins there and the red losses. There's more green wins and there's fewer red losses. Hence the accounts making money, which is the name of the game.
Now let's take a look at the tutorial section. Now this tutorial area is one of the most critical areas of the entire software. The course that you're on now is taking through the basic overview of Smart Charts, but for those of you that really want to get to know all the ins and outs of the software, I strongly recommend that you spend some time in this tutorial section watching each video, perhaps multiple times, to fully understand all of the different aspects as to what's going on. As new videos get released, they'll appear here as well. We want to make sure this is your one-stop shop for where you go to for any of your smart charts questions, queries, or issues with the software. This is the place for you to come because there's always a video here to help you work your way through it. The next section for us to take a look at is the coaches section. Now, the coaches section allows you to see different coaches from around the world. So we'll be able to see the coach's name, you'll be able to see their location, how long they've been trading for, and you'll also be able to see their style that they trade in. There's then a full bio here where you can see their trading experience, their style, some of the reasons why they started trading, and the markets that they choose to trade with their own real money. There's also then their favourite trading systems and favourite trading strategies and some of their personal hobbies as well. As you can see, we've got coaches from around the world, several from the UK, we can see others from Australia. If I scroll down through this list, you'll be able to see some coaches from South Africa as well. So there's coaches in lots of different regions from around the world with differing levels of experience. You'll see some people with 3 or 4 years of experience, others that have got 16, 30 and even more than that years of experience. You'll find that coaches are able to help you achieve the best possible results by taking what you're doing right now and then taking your trading to the next level by taking out some of the mistakes that you're making and helping you to improve and speed up your trading journey. Now, as an extra section for you here as well, we've now got the Trader TV section. We actually put out 4 different videos every single week, with most clients receiving around 2 of those videos. It depends on what you choose to go for with smart charts, but if you're just looking at forex to begin with, it's likely you'll get 2 videos come through on a weekly basis, and we actually keep a whole archive on here for you, so it's a whole additional section of long-term online learning for you. Now, the recent videos will show those videos in the last 8 weeks that you're able to take a look at, and you'll see different videos from different traders on a variety of different subjects. We've then got the top rated videos. This is the absolute best stuff that's out there that you're able to watch back again and again and again, and you can even download these videos if you want to and keep them on your own computer. We've then got videos that you can search for by course. So you can actually say, okay, let's see that the video is from the Learn Forex course or general content videos and things like that. And you can see videos on a course-by-course basis. And finally, there's also a search section here as well. We're able to search for different things. For example, if I search for smart charts, I'll be able to see videos on the smart chart software. And we can see there we've got 3 different videos, new smart charts features, basic points on smart charts, and also how you can prosper this year with smart charts as well. So this Trader TV section is somewhere you're going to be coming back to on a regular basis for lots of fresh new content delivered by our coaching team from around the world. Now, to make sure that you stay out of a spot of bother, we've now got the economic calendar that I'm going to show you, and we bring through all the low, medium and high impact news releases on a variety of different currencies and tell you what's coming up and when. We tell you the name of the news release, how important that news release actually is, and the time of day that it comes out as well. The news release is also time coded to your computer time. That way you know whatever your computer time is in the bottom right hand corner of the screen is the same times that these will revert to. Now, looking at low, medium and high impact news, it's only the high impact stuff we tend to really focus on, and you'll hear more about that in further modules throughout the course. And if you really want to get into the nitty-gritty of this, you've now got the whole news section with full-on articles that you can read. Now, I want to stress that this is not necessary. Most people actually never even visit this section, but it is there for those people that really do want to go into the depths of this and find out absolutely everything that's going on a fundamental basis. All you need to do, very simply, is left click on the link and you'll be opening up, looking at an article with far more detail than perhaps you need to see, but giving you a full insight into what's going on in the market. So overall here we can see, looking at this, there's several different areas that you're going to spend your time, from the journal area through to the tutorial area, the Trader TV section. There's lots of fresh new content coming out on a regular basis, and the journal section where you're going to be able to monitor your own trading performance, and of course you're going to be able to see what you're doing well, what you're doing not so well, and you're going to know where you need to be focusing on to improve your trading performance. So to summarise, the three main areas that you're going to be looking at in the bottom left-hand corner of your screen down here are called the SC Connect area, the SC Trade Ideas area, and the SC Trade Terminal section. So we have the Connect area here, and the Connect area is, again, like the home page of our website, where you see your journal, tutorials, Trader TV, coaches, news calendar items, so on and so on and so on. The Trade Ideas section includes a scanner and trade alerts from different coaches around the world, so you can see what's setting up in the markets right now. And the Trade Terminal section down here is where you go to see how your current trades and current orders are doing right now. Are you making money? Are you losing money? Are you pending orders there still? That's where you go to see what's going on for an instant snapshot of your account.